Welcome to an in-depth look at the Federal Reserve's interest rate policies and their impact on the economy and financial markets. In this video, we will explore the history of the Fed, its functions, the relationship between interest rates, unemployment, and inflation, and how markets react to rate cuts. Investors and economists know the significance of interest rate decisions. Understanding the mechanisms behind them can provide a huge advantage. We'll examine how different phases of the market cycle, from euphoria to capitulation, unfold, and how interest rate changes influence these cycles. Additionally, we'll analyze historical examples and offer practical tips for investors on how to navigate a low interest rate environment. Stay tuned. It's going to be an exciting and informative journey. 1. The founding of the Federal Reserve. A look back in history. To understand the current role of the Federal Reserve, it's essential to look back at its history. Before the creation of the Fed in 1913, the United States lacked a central banking system, leading to recurring financial crises where banks failed and the economy suffered. A turning point came during the Panic of 1907, a severe financial crisis that caused markets to crash and public confidence in the banking system to evaporate. This crisis made it clear that the U.S. needed an institution to control the money supply and act as a lender of last resort during financial turmoil. The Federal Reserve was created to meet this need. It was tasked with ensuring financial stability, managing monetary policy, and providing the country with a reliable currency. Over its more than a century of existence, the Fed's role has evolved from a crisis manager to an institution that steers economic growth and inflation. 2. The structure and functioning of the Fed. The Fed is not a monolithic institution. It operates on multiple levels that work together to shape U.S. monetary policy. At the top is the Board of Governors, a panel of 7 members who are appointed for 14-year terms. These long terms ensure their independence from political influence. In addition to the board, there are 12 regional Federal Reserve banks that serve as a bridge between the central bank and local financial markets. Each of these banks oversees its respective region of the U.S., helping tailor monetary policy to local economic conditions. The most important body in the Fed's monetary policy decisions is the Federal Open Market Committee, FOMC. This group regularly meets to decide the federal funds rate, a key interest rate that impacts borrowing, investing, and spending across the economy. The Fed's goal through these measures is either to stimulate the economy when it weakens or to cool it down when inflation gets out of control. 3. The yield curve, a key indicator for investors. One of the most important tools for assessing market sentiment is the yield curve, which shows how yields on government bonds vary across different maturities. Particularly insightful is the comparison between 10-year and 2-year Treasury bond yields. Normally, the yield curve is upward sloping, meaning long-term bonds offer higher yields than short-term bonds. This reflects an expectation that the economy will grow in the future and higher interest rates will be necessary to control inflation. However, when the yield curve flattens, with short and long-term yields nearing each other, it indicates uncertainty about future economic growth. Most concerning is an inverted yield curve, where short-term bonds offer higher yields than long-term ones. This is often a precursor to a recession, as it signals that investors expect the Fed to cut rates in the future to boost the economy. Historically, an inverted yield curve has foreshadowed many major recessions. In recent decades, this was true before the early 1980s recession, the bursting of the dot-com bubble in 2000, and the 2008 financial crisis. The historical impact of interest rate cuts. When the Fed cuts interest rates, it typically does so to support a struggling economy. However, rate cuts have both short and long-term consequences. For example, in the 1980s, the Fed raised rates dramatically to fight rampant inflation. This move led to a recession but was ultimately successful in bringing inflation under control. Rate cuts in subsequent years helped stimulate recovery. Another example is the response to the bursting of the dot-com bubble in 2000. At that time, the Fed aggressively cut rates to restore confidence in the economy. While these rate cuts did help boost economic activity, They also contributed to the housing bubble, which eventually led to the 2008 financial crisis. These examples show that while rate cuts provide short-term relief, they often come with long-term risks. For investors, it's crucial to view rate cuts not just as immediate solutions, but as part of a larger economic cycle. 5. Market cycles. From euphoria to capitulation. Financial markets follow clear cycles that are often closely linked to monetary policy. These cycles can be divided into 3 phases: euphoria, accompaniment, and capitulation. The euphoria phase is marked by strong market gains and an almost unlimited level of investor confidence. It seems as though the market can only go up. However, in this phase, investors often overlook growing risks. A classic example is the rise of tech stocks during the 1990s dot-com boom. The accompaniment phase is where sentiment begins to shift. Early warning signs appear, and market volatility increases. Investors start to take profits, and market performance becomes more inconsistent. It's critical during this phase to stay alert and watch for signs of market overheating. The capitulation phase is when markets hit their lowest point. In panic, investors sell their positions to minimize losses, causing sharp price declines. This phase can be particularly painful, but offers the greatest opportunities for long-term investors. 6. The impact of rate cuts on different asset classes. Interest rate cuts affect various asset classes in different ways. Stocks usually benefit from rate cuts, as companies can borrow more cheaply to invest and expand. However, rate cuts often signal that the economy is weakening, which can weigh on corporate profits in the long run. Bonds react differently depending on their maturity. Long-term bonds tend to benefit from rate cuts because their fixed interest payments become more attractive. On the other hand, short-term bonds offer little yield in a low-rate environment. Real estate often sees a boost from rate cuts, as lower mortgage rates make property purchases more affordable. However, there is always the risk of a bubble forming in the real estate market if low rates persist for too long. Commodities, especially gold, become more appealing during times of rate cuts. As rates are often reduced in response to economic uncertainty, gold serves as a safe haven for investors seeking to protect their wealth. 7. How investors should act in a low-interest rate environment. In a low-interest rate environment, investors should rethink their strategies. Diversification is crucial to minimize risks and capitalize on different market trends. Defensive sectors, such as utilities or healthcare, may offer stable returns, even if the economy struggles. Dividend stocks are also an option, as they provide regular income and potential for capital appreciation. Investors should also ensure sufficient liquidity in their portfolios to react quickly to sudden market shifts. Finally, maintaining a long-term perspective is vital. Rate cuts often create short-term uncertainty, but for investors with a clear plan, they can also offer significant opportunities. Conclusion: rate cuts are a powerful tool of monetary policy that come with both opportunities and risks. For investors, understanding the mechanisms behind these decisions and preparing for their long-term effects is crucial. Historical examples show that rate cuts often precede significant economic changes, and investors need to strategically plan for them. Thank you for watching this video. If you'd like to learn more about economic concepts and investment strategies, be sure to subscribe to our channel. See you next time.